Hello, good morning, good afternoon, and good evening to our global participants in today's webinar, Considering EMX China, Strategies to Right-Size Your China Exposure. My name is Jonathan Schellen. I'm the Chief Operating Officer here at Crane, and I'm delighted to be joined by Anthony Sassine, who's a Portfolio Manager and Head of MENA. Now, before we get started, just a couple of housekeeping items for you to consider. We want this to be an interactive discussion. So if you have questions, please send them through the Q&A button at the bottom of your screen if you're using Zoom. And if you're streaming this on the website, please email your questions to info@KraneShares.com. Additionally, we're offering one CMA and CFP credit for this webinar. So if you want those credits, please email ce@KraneShares.com. So you may be asking, why is KraneShares, a company that's historically known for its deep Chinese expertise and thematic ETF lineup, why are they talking about EMX China, Emerging Markets X China? Well, turns out we view Emerging Markets X China as China as two sides of the same coin. And throughout this webinar, we're going to help you answer three very important questions that I think are particularly timely right now. The first is, should you be owning emerging markets at all? Should EM represent a part of your portfolio? If so, how do you make the decision to split between emerging markets, excluding China, and China itself? And then three, how frequently should you be revisiting this kind of decision in your portfolios? So Anthony and I will go through and help answer these very important questions. A little bit of background on Crane for those of you that don't know us. We founded the firm 10 years ago and began by launching ETFs on the New York Stock Exchange. Over these 10 years, we've grown in size, and we now have 39 ETFs globally, with right around $9 billion in assets under management. And another thing that's really important to note is that roughly 3 years ago, because of the questions that we were receiving from our clients as they were building their own portfolios, we started a portfolio business. In other words, we started helping our clients understand how they should be putting these ETFs together in a way that helps them either maximize their return opportunities, minimize or reduce risk in portfolios, or do some combination of the two. Let's jump to the next slide, please. You could see that across our lineup of ETFs, we think about them in three to four major categories. As I'd mentioned, we started the business with a focus exclusively on China. And so you could see many of our well-known China thematic ETFs on the far left, KWEB being our flagship, but we also have great strategies in the healthcare, clean tech, and consumer space. And our expertise in China has allowed us to branch out into other parts of the international investment sphere, namely Pan-Asia, both in equity and fixed income, but also in EM consumer, and a strategy that we're going to spend some time today on, which is the KraneShares Dynamic Emerging Markets strategy. And we'll go deep into that. And several years ago, we also entered the climate space. We managed the world's largest global carbon credit ETF, KRBN. And this is very much in line with the way we think about the world, because the reality is, if you want to solve the world's climate challenges, China's going to have an important seat at the table, being the world's second largest economy. And last but certainly not least, we also have a series of funds that focus on uncorrelated return streams or uncorrelated assets. And so we've got some well-known strategies there like IVOL and KMLM that are really also important components of people's portfolios. So that's our product suite. As I'd mentioned, we're going to spend today spending time on emerging markets, ex-China, China, and our KEM ETF. Let's jump to the next slide, please. So for context, I mentioned early on, should investors own emerging markets, and how should they own them if they should? Well, it turns out that the US plays a very dominant role in most portfolios. And what's interesting, though, is when you consider the size of the US economy, which is only about a quarter of global GDP and about a quarter of global GDP growth, what's surprising to some, it's certainly surprising to me, is that the US actually represents over 60% of the MSCI All-Country World Index. So even though the US only represents about a quarter of the global economy, the world economy, it represents twice that much, more than twice that much, in terms of recommended weights from the very popular MSCI All-Country World Index. And that actually crowds out the exposure to developed and emerging markets. Turns out that developed and emerging markets represent 2/3 of expected global growth and even historic global growth. And yet emerging markets, which represent emerging markets ex-China and China, only represent 11% of the all-country world index. So if you knew nothing about investing, you would lean towards investing in line with a major index, but it seems to fundamentally underrepresent the weight of emerging markets. Let's jump to the next slide. But even if you say GDP isn't the way we should be thinking about investing, well, what about the full market cap? What about the investment opportunity that exists? And what you'll see is, looking at the investment opportunity, the size of the various markets around the world, developed markets make up 80% of the global opportunity, and emerging markets make up 20%. So we believe that for most investors, having this 80-20 split between developed and emerging markets actually makes a lot of sense. And what's more, if you go a step deeper and look at the split between emerging markets ex-China and China, they're almost at parity. That about 50% of EM is made up of the China opportunity, and about 50% is made up of emerging markets ex-China. And this shouldn't come as a shock to anybody. China is the world's second largest economy. In fact, China's economy is larger than Japan's, Germany's, and India's economy combined. China also boasts the world's second largest equity market and the world's second largest bond market. So from an opportunity set standpoint, China is too big to be ignored. Next slide, please. What else is interesting about China, and viewing it through a slightly different lens, is the pattern of returns. When we talk to investors, a lot of them will say, well, I get my China exposure by investing in emerging markets. But the truth is, the returns that you get from China can be very different from the returns that you get from the rest of emerging markets. Sometimes the return difference is positive, and sometimes it's negative, but the point is, it's really quite different. Take, for example, even this year to date, China and emerging markets ex-China have a 14% return differential. Last year was kind of anomalous because the return differential was only 3%, but if you go back to 21 and 20 and other years, you'll see that the return differences are much larger, oftentimes greater than 20%. And historically, the average is about double digits. So this difference between China performance and emerging markets ex-China performance is very important to understand when putting together your portfolio. And because of this correlation benefit, even though China appears risky on paper, right? When you follow the white boxes, you'll see that the white boxes that represent China returns year over year can be at the very top. They can also be at the very bottom. But when you think about this cycle that China's economy is on, it actually is beneficial for portfolios. Let's jump to the next slide, please. And so if you look at classic, financial theory and you put together your efficient frontiers, what we found is that by looking at the last 20 years of history for China and emerging markets ex-China, a portfolio that's roughly 60% emerging markets ex-China, 40% China, tends to be quite efficient. And even though China in and of itself is more risky than the rest of EMX China, by blending these two pieces together strategically, using a 60-40 weighting, a simple strategic 60-40, you end up having less risk historically than emerging markets, and higher returns as well, because China has actually outperformed the rest of EM over the last 20 years. And this is our own proprietary analysis and is focused very much on long-term returns, but you don't have to take our word for it. If you go to the next slide, you'll see that Goldman Sachs produced similar analysis. And while we were focusing on the highest return for a unit of risk, they showed that you can have less risk for any level of return. So just kind of flipping the problem on its head. But using long-term data, arrived at a very similar conclusion, that having a strategic allocation to China, a meaningful exposure to China, separate from EMX China, is an important way to invest. And they went even a step further and talked about the importance of the A-share market, which is China's mainland stock market. I should mention that normally you can invest in Chinese stocks in the A-share market, which is the Shanghai and Shenzhen exchange primarily. Also, you can buy Chinese stocks on the Hong Kong exchange, and there are also Chinese securities listed as ADRs on the US exchanges. Next slide, please. And many of you may be saying, well, geez, 20 years is a long time. And most institutional memories don't go back that long. And when you think about EM investing, it turns out that most investors right now are heavily underweight emerging markets, and they're also heavily underweight China. Why would that be? And the answer is actually pretty straightforward. I think it has a lot to do with the returns that people have observed, not over the last 20 years, but really over the last 10 to 12 years. In fact, it's kind of amazing. If you look at the S&P performance from April of 2012 to October of 2023, the S&P is up 12%. So this is kind of the second column over, or fourth column over, rather. The S&P's been up an average of 12% a year for this entire period. That is phenomenal performance. But EM, emerging markets, are only up 2.5% over the same time period. So the S&P has outperformed emerging markets by a huge margin over the last, call it 12 or so years, 11 years. And if you look back, and the other thing I would mention, and this is really important, in almost every 3-year rolling period in this time frame, the S&P outperformed emerging markets. So not only was the outperformance massive, significant, the percentage of time that you outperform with the S&P was almost 100%. Now, what's interesting is if you reverse back to the decade before the last one, you saw almost the exact opposite. Emerging markets outperformed the S&P 13.3% to 1.4%. So huge performance difference. And in that instance, the emerging markets outperformed the S&P in 99% of the rolling 3-year periods. So even though over the full 23-year period, emerging markets and the S&P look pretty similar, it really was a tale of 2 decades. And one of the driving factors that shouldn't surprise anybody is the behavior of the dollar. In the period where emerging markets outperformed the S&P, the dollar was declining by about 3% a year. Whereas in the period where the S&P outperformed emerging markets, the dollar was appreciating by an average of 2.6% a year. And so think about where we are today, where the Fed is on the verge of a potential pause as inflation settles, and the dollar has had a decade run plus of strength. So we may very much be entering a period that looks much more like early 2000s than the last 12 years. And that's also important for investors to bear in mind as they think about the role of emerging markets in their portfolios. Next slide, please. And digging kind of a layer deeper, you'll also find that the performance cycles between China and emerging markets ex-China can be lengthened. And so you can have, multi-year periods where one outperforms the other. And this is one of the challenges that we faced when we were thinking about how do you invest in China, knowing that you have to have exposure to both, but that one can underperform the other for an extended period of time. How do you mitigate that risk? How do you deal with this volatility? And that's something that we'll talk about as we get into our KEM strategy. Next slide, please. The other thing I'd want to highlight as background is this notion of emerging markets being inefficient markets. One of the things that we saw, and even, kind of early in my career, I witnessed that most emerging market investments were made actively. And so when people invested in emerging markets, they would say this is an inefficient market. And so therefore it is very well suited for stock pickers, for active managers to find the right companies to buy the best performers, to avoid the risk. But what you'll find, and this is just us looking at the Morningstar universes, is that the assets allocated to emerging markets have systematically shifted away from active and towards passive. And we're now at a point where roughly half of the investments, if you think about the 600 billion or so that's invested in emerging markets funds, about half of those funds are dedicated to active investments and half of them are dedicated to passive investments. So this is really interesting where the market has said, I haven't quite given up on active management in emerging markets, but clearly something as it pertains to stock picking or efficiency in EM isn't working the way it once may have. Next slide, please. So before I jump in and introduce some of the work we've done in allocating to China and emerging markets ex-China, I wanted to highlight our team. We have a phenomenal team here. My co-portfolio managers, Anthony Sassine being one who's on the webinar today, is also accompanied in managing the portfolio by James Maughan, who has deep capital markets experience, runs our capital markets group, and helps us trade the strategies. Anthony has spent the lion's share of his career involved with emerging markets in China. He is a China expert. He's an emerging markets expert and has really been involved in managing portfolios and consulting on portfolios going back throughout much of his tenure. And then, of course, Robin Zhang is a phenomenal phenomenal quant analyst for us. She makes sure that everything we do analytically, data quality wise, and in terms of best practices in model management is being upheld. And so she's a phenomenal addition to the team and has been with us for a couple of years at Crane. So overall, a deep research, heavy focus on emerging markets, and being able to leverage not just the broader firm's resources in building portfolios, but also individual expertise of the people on this team. Next slide, please. So let me introduce our dynamic emerging market strategy. We're trying to solve this puzzle, and the puzzle is this. We know you need to own China and emerging markets ex-China. China is its own asset class, and we at Crane have two ETFs that give you exposure both to all of China, and it's called, the ticker is KALL, KALL, and it's the KraneShares All China Index ETF. And then we also have its complement, which is an emerging markets ex-China ETF, and its ticker is KEMX. And if you put these together in some neutral way, you're going to get broad-based emerging markets exposure. But we asked ourselves and challenged ourselves, can we do better than that? Rather than just putting them together strategically and giving you broad EM, how do we manage some of the risks that we discussed? How do we manage the notion that there could be long cycles where emerging markets can outperform or underperform other equity markets, or that emerging markets can face severe drawdown, or even one of these regions within emerging markets could face severe drawdowns, or become incredibly cheap, quite frankly, and produce an opportunity. So these are all the types of questions that we sought to answer when we were building this ETF. And what we've come up with is a dynamic asset allocation strategy that allows us to rebalance the portfolio at least quarterly. But this is not just strategic rebalancing to a fixed weight, it's dynamic rebalancing that allows us to overweight and underweight the China exposure. Next slide, please. So just to give you a snapshot, what does the portfolio look like today? The portfolio today has three components, and it'll always have at least two of these three. Right now, our portfolio is 54% invested in China, 36% invested in emerging markets ex-China, 10% in cash. And just in the last couple of months, the model has shifted to effectively a maximum overweight position in China. And as Anthony will highlight later on, that's not been the case historically. It's only now, and since the launch of this fund, that we've gone maximum overweight China based on the signals that we've produced. At the same time, the model is also indicating that we're in a higher volatility period, so we also have a 10% cash position, and that is our limit for cash. We will not allocate more than 10% to cash, but the cash can drift above 10% if the other markets decline. So this is pretty unique positioning for our model. But that's why I'm so pleased that we were able to launch this ETF and bring this to our investors to take advantage of the opportunities that exist right now in the markets. Next slide, please. So why would one consider the dynamic emerging market strategy that we've produced? Well, one, risk management that we talked about. We're dynamically allocating between these ETFs and cash to control risk. It's easy to invest. You could buy this ETF the same way you would buy any other ETF or stock, right from the New York Stock Exchange through a brokerage account. And of course, alpha potential. We're not trying to replicate the broad emerging markets. We're trying to do better than emerging markets through active management. But bear in mind that our active management isn't picking stock A versus stock B. It's through dynamic allocation and portfolio construction. Next slide, please. And I've covered a lot of these points, but just to highlight very quickly, what are the parameters around us managing this? Well, for one, our benchmark is something, it's the broad MSCI Emerging Market Index, which currently has a weighting that is 71% to emerging markets ex-China, 29% to China. So that's our benchmark. And then we can allocate plus or minus 30% away from those weights. So in essence, we can go as high as 59% China or zero China based on the current composition of the benchmark. This gives us ample latitude to make money or protect the portfolio given market conditions. And this is not a black box. I want to highlight that, we've all been around long enough to know that you don't want to have a framework or a model that's not explainable. So all of the things that we look at to drive the model are very well established characteristics based on fundamentals and some technicals as well, vis-a-vis moving averages. So very transparent framework, rules-based, and we follow the model. We've had many times where the model gives us results that we're quite surprised by, but it's systematically taking advantage of market opportunities. And we want to do that without infusing our own kind of emotion or perspective at a particular point in time. Next slide, please. And philosophically, I'll just share this slide before turning things over to Anthony. One of the things that we believe, and I think you've probably gathered from our discussion thus far, is, you have to understand that China should be its own asset class. And historically, it's been hard to view China as its own asset class because of data availability. Even doing some of the analysis that we did on historical returns and extracting historical China returns versus emerging markets ex-China has been hard to do. So you can imagine how difficult it is to access data on fundamentals and digging in at the stock level. So we rely on what we think are best-in-class data sources for the work that we do. And that, of course, involves data sources from MSCI and Bloomberg and FactSet. But the bottom line here is we recognize that the relationship between China and emerging markets ex-China is one that's quite volatile. And there are periods of time where, because of the market inefficiency, China can meaningfully overshoot or undershoot performance of the other market from a fundamentals perspective and from a risk perspective. So we believe that we can make the most of those circumstances, and that's why we've created this framework. And our goal is to help you build better portfolios. Now, I'm going to hand things over to Anthony, who will talk a little bit more about the history of the strategy, but also give you an overview of the emerging markets and our outlook. Anthony, over to you.
Thank you so much, Jonathan, and thank you all for joining us today. So basically, what we're discussing here is a new way to kind of approaching emerging markets. And we launched that ETF not too long ago, back in August. So we have a very short track record that you see here. But also, please keep in mind that strategy was launched as a model 3.5 years ago at KraneShares. For compliance reasons, we cannot show it here, but if you're a financial professional, financial advisors, please give us a call at info@kraneshares.com, or you can also go to the KraneShares model portfolio sign up and see performance for this strategy all the way back to December of 2019. So basically, since we started, you see in the red line, KEM, it's doing well because two things. One, it's now in cash, 10%, and the market has been going down. And this is the power of having this little bit of a cushion, especially in kind of down markets, where you're able to cushion your downside, right? So this is not designed to be a market timing tool or to give you a full protection, but it's just a little bit of cushion during down markets using moving averages and generating downside protection and generating alpha versus the benchmark. Next slide, please. So basically, just to get you a little bit into the nuts and bolts of the index, the way we do it. So there's the three main ways where we would rebalance the ETF. One is on a quarterly basis, we run some of the signals that we just mentioned. It's not a black box. These signals are based on widely used multiples and indicators that you use every day in evaluating stocks or ETFs. That's PE, PB, forward PE, long-term growth, yield. These are encompassing fundamental and technical aspects. So we, working with Robin here, we kind of generate Z-score on a quarterly basis to see which side is cheaper, which side is more expensive. And then based on the scale, depending where the Z-score is, we allocate either overweight China or underweight China versus MSCI EM, right? So if MSCI EM now it's 71% EMX China, and 29% China, depending on the scale where we are, we can allocate +5, +10, +15, or +30%, either way, depending on that Z-score. And the second reason where we would rebalance on the next slide is if the moving averages move in a way that kind of indicate that there's a bearish period coming up. If you see here, you look at the 20-day moving average, 50-day moving average, we've done a lot of research in that space. And the 20-day and the 50-day are very good predictors, in our opinion, of what may come in the future, right? And as you can see here, the second they cross, we take 10% to cash, right? And then the third way the reason we would rebalance the ETF, it's because of an opportunistic rebalance. So as Jonathan mentioned, our philosophy, right? It's three main tools here, the three main stools. It's one is China should be its own asset class. Check. We have emerging markets like China and China. Two, emerging markets in China can be volatile, can overshoot and undershoot, right? And this is where we use the opportunistic remodel here, where if the gap in valuation fundamentals between China and ex-China reaches more than 1.7 or 1.8 standard deviation, we allocate a full 30% towards the the cheap side, right? And now we're plus 30% in China because if you go back a little bit in this year, or actually for the past year in emerging markets, November 2022, almost a year ago, China announced its reopening. Within the next 2 months, MSCI China was up 60%, and EMX China was up or maybe down even a little bit. So that gap kind of created in our model a signal saying, hey, emerging markets ex China is way cheaper now, and it may, it warrants an opportunistic rebalance. So in January of 15th of January of 2023, the model was indicating we should be 95% in EMX China, 5% in China. And we did that. And then over the next 6 months, we saw EMX China come back, outperform China by close to 16%. And that was the craze for AI, Taiwan Semiconductor, Samsung, all the semiconductor companies ran up in a big way. Even Brazil and also oil-facing economies were doing well. It kind of indicated that China is a lot cheaper today. The gap between China and ex-China is 1.7 standard deviation. So that's why we kind of went plus 30% in China. And then by August, the moving averages, as you can see here, the red line crossed the green line, and so we allocated 10% to cash. Hence our current positioning right now, which is 59% or 55% in China, 10% in cash, and the rest is in emerging markets ex-China. Next slide, please. So basically, this is how we look today. We're overweight on China, 54% versus 28.8 for the index, but then we're underweight on emerging markets ex-China. And then we're 10% in cash, of course. Next slide, please. So now this is basically how the emerging markets, the KraneShares Emerging Markets Dynamic ETF works, right? It's based on three main points here in our philosophy. China should be its own asset class. Emerging markets ex-China and China can be volatile. And also emerging markets in general can have a strong downside. That's why protecting the downside by having the option to move 10% to cash can actually help mitigate, can help generate alpha. So based on that, we took two ETFs, emerging markets in China, ex-China and China All Shares, which has the full inclusion of A shares. 50% of that is A shares, and then in cash. And we're allocating based on widely used multiples, widely used signals like PE, PB, forward PE between the two, and also allocating based on moving averages when they cross to cash, and based on opportunistic as well, when the volatility is at its extreme, and we know that mean reversion is a very high probability. So now let's move on a little bit to talk about the outlook, what's happening in emerging markets, and just can I give you our thoughts in that space. Basically, if you look so far this year, it's been, as I said, it's been emerging markets like China outperforming 9% compared to China minus 7%. And, China's economy went in very strong into, or the market went in very strong into this year, but kind of the market surpassed expectations with regards to economy. The recovery from COVID in the last 2 years hasn't been as fast as investors hoped for, but we're seeing a big improvement now in that economy over the past 2-3 months, mainly related to real estate. We're seeing a little bit of consumption coming back, and we're seeing the government continue to stimulate, in addition to positive green shoots here between the U.S. and China, which we've seen it culminate yesterday in a big meeting between President Xi and President Biden. On the emerging markets ex-China, it had a really great year so far, mainly driven by AI. The announcement of ChatGPT kind of opened up the AI space in a big way, right? And now after seeing what ChatGPT can do, we can see that so many applications can be derived from this. And what that means is that the AI age is on now, and we're going to need a lot of chips in the future that are very high performing chips that only very few can do, including Taiwan Semiconductor, Samsung, HK Hynix. So Hynix. So these are the companies that actually drove the performance in emerging ex-China for the first 6 months. In addition to that, Brazil has been a very strong also performer, up 10.87% so far up this year. And India, which has been very surprisingly resilient over the past 2-3 years, a consistent outperformer in emerging markets, due to there's so much opportunity in that country, but despite high valuation. If you look on the right side on the sector basis, it's also reflects the performance of the information technology sector, which is really based on semiconductor companies, and also energy. They've done really well. Consumption with consumer discretionary and communication services, not as well, and that's mainly driven by China. Despite very good earnings, encouraging earnings from Alibaba, Tencent, and the likes in Q2, and now we're seeing them beat again in Q3. Investors have not responded as well, right, to these beats in earnings, and that's why we think now China, as we go forward, China is very well positioned here from a valuation perspective and also from growth potential perspective to kind of outperform in the next 2-3 years, and also emerging markets ex China as well. We're not going to discount the potential growth that is coming up in the next year or two from AI, especially in Korea and Taiwan, and some of the oil countries, including Saudi Arabia and also Brazil and India. Next slide, please. So basically, what's been happening recently is also the U.S. dollar has been a big headwind for emerging markets, and it's usually the direction of the U.S. dollar has been also correlated with the outperformance between S&P and with the outperformance of S&P over emerging markets, right? And as you can see on the chart on the left, there's a 0.78 correlation with the movement of the US dollar. And that's very normal because, when you have high USD, you have a big currency impact on emerging markets. It also impacts the companies locally, especially if that's accompanied by increasing yields in the US. And many of these countries have interest rates really kind of correlated with the US. So as US yields increase, yields in Korea and Taiwan, there's a pressure on yields in Korea and Taiwan, and any country that is really pegged to the US dollar to increase that yield as well locally and increase the cost of capital on companies, and that's kind of impact growth in the short term. So recently, we've seen a big run up in the 10-year yield that is actually starting to break down today. And, that could have a very good impact for emerging markets. So going forward, looking at the USD, looking at the US yield can be a very good indication that emerging markets can come back now and actually have a tailwind as the USD starts to decline from its very high levels today. Compared, we haven't seen the USD so high since the dot-com bubble in 2002. We're starting to see that breakdown, right? Recently, we saw the yield drop by 50 basis points in one day. We're getting signals from the Fed that this is a top in terms of interest rates. We're actually starting to see banks actually factor in rate cuts next year, which is something we expected because, historically, we've always, especially in the recent history, we've always seen the Fed trying to catch up with the market, with regards to rates. They didn't anticipate inflation, so we had a year of, where they had to raise rates by 5 or 6%. And I think now at this point, we're gonna get a surprise from unemployment or lack of growth, and then the Fed's gonna start to have catching up with the market, and that means more rate cuts, and that means a big decline in the US dollar, and which translates into a big tailwind for emerging markets in China. Next slide, please. So when you look at China, let's focus a little bit on China. China is trying to recover from the last 2 years, from lockdowns, from regulations, and the recovery this year has been slower than expected, especially on the consumption side. So one thing I am watching in China is consumer confidence. We want that consumer confidence to come back, and that's related to really two things in China. Maybe three. Well, basically real estate, right? Because most of the wealth in China is in real estate, and also youth unemployment, right? Because now we have it at like 17 or 18%. youth unemployment. So if you're a head of a household, your home's value is coming down, your son is unemployed, you're not going to have an appetite for spending. We're seeing now spending on small tickets. So if you look at the major headlines, retail sales up 7.6%. Last 2 months, it was more 3 and the 5%. But online retail sales has been consistently in the double digits since May. So we're seeing more growth on the e-commerce side, which helps the Chinese internet companies. We're seeing more growth on companies that are actually doing smaller tickets like services or even experiences like travel. C-Trip and companies like that, they're doing a little bit better than the bigger ticket companies that you see who sell furniture, appliances, or even that are working in the construction and real estate side. Next slide, please. Also, you see this kind of a similar dynamic on the fixed asset investment side, where our governments are investing this year, right? So, and you see the growth is a little bit on the lower side, 2.93%. A lot of that is coming from state-owned enterprises, and China continues to cut rates. We've seen them do that for the last 2 years. Initially, it was very helpful, and the market responded very well. But then recently, we're starting to see the impact of rate cuts to be lower on the market, lower on the economy even, because as you can see here, despite all the rate cuts, private companies are still not investing. They're still negative 0.5% in October, and it's been consistent for a few months. So what we're looking for here is more of a demand side type of stimulus, right? That will help consumer confidence, that will help demand, and that will encourage private companies to start investing and hiring again, right? So that's what we're looking for. But even if you peel the onion a little bit here, you still see that some sectors are doing a lot better than others, right? So sectors related to renewable energy, solar, EV, high-end machinery, like the semiconductor industry in China is on fire. It's getting a lot of investments from the government. We saw Huawei roll out a 7 nanometer chip recently, which was a big surprise. That's energizing the whole industry, energizing investments into that industry. And it seems like despite all the restrictions that is coming from the US, China is able to create such high-level, high-functioning chips. And that's not a surprise for us, right? This is one thing we like about China. That's why we invest in China. We recommend investing in China. It's because that economy is very resilient. The innovation there is at a very high level. And every time you put an obstacle in the face of that industry, or in the face of that country, they find a way to overcome it, right? And that's why we like China for the long term. Next slide, please. So basically, when you hear a lot of doom and gloom in the media because on China, China is going to have a hard landing, systematic risk, etc. Really, the people who are saying that, I don't think they understand China very well, right? Because China has every tool to maintain its economy, to control its economy. Think about that, right? Like the balance sheets of China are some of the best in the world. You have the government that has like 3 trillion in reserves. That's in addition to 1.5 trillion with CIC, which is the sovereign wealth fund, and another 1.1 trillion of also additional funds that are on the balance sheets of the major banks. These are all can be used for China to be able to be used internally on our economy. Second, you have very high net savings within the consumers in China right now because they haven't been spending over the next 2 years. Three, China's debt to GDP on a federal level is 50% compared to the US, 120, compared to Japan, 240. So China has a lot of leeway. And we saw recently that China started, actually raised 1 trillion from debt, federal debt, to kind of start investing in infrastructure and giving them to local governments. Well, that's a good move that they're starting to think about expanding their debt to GDP ratio, which we believe can be expanded by at least 10-15%, right? Because, it's still so low. But we would like to see those proceeds used for demand side stimulus, right? Not just infrastructure and rate cuts, but actually helping consumption, right? So on the right side, you can see what are some of the things that we think China can do to kind of shift market sentiment, shift investor sentiment, and help lift consumer sentiment. A fund to support weak developers and real estate. And actually, if you have been following the news 2 days ago, there was an article by Bloomberg saying that China's mulling creating a 1 trillion RMB or $137 billion fund to support real estate and actually to build low-end or cheaper houses and give them to consumer. This is great. This is exactly what you need. You need a transfer of economic gains from industries and SOEs to actual consumers, right? Through policies like that. Even if you give people like free subway rides, that's transfer of economic gains. Any policy like that can impact, lift the spirits, lift a safety net for consumers is very welcome. Even subsidizing hiring like we did in the US, where if the internet economy, or which has been the main driver of growth, main driver of hiring over the past 2 years, hire more talent, right? They get a big tax credit. Why not? So these are the type of things that you want to see from China happen in the short term. And on the emerging markets ex-China, actually, although now we're fully overweight on China, I can see that going for the next quarter or two or maybe three, right? Until the gap between emerging markets and China closes. It really depends also on the government in China. If they announce some of these policies sooner, right? If we have some great news like we did from the APAC yesterday, this gap could close much sooner. But also don't underestimate the growth of next year for emerging markets like China. Actually, Korea is expected to grow, equities expected to grow at 40% next year, because we're expecting the semiconductor industry, the traditional one, not just AI. AI is humming along, but the traditional one has been in a slump for the past 2 years because we've had extra inventory on semiconductors, right? We've seen because we had a strong 2020, 2021, and that inventory is getting to a level where it's depleted now. We're starting to see the prices of chips, the DRAM and the NAND actually return a little bit, and that's gonna pick up more in 2024 as we have less inventory and as the technology cycle kicks off again. Next slide, please. So this is from APAC yesterday. Great meeting between President Xi and President Biden. This is exactly we want to see communication between the two. This is a culmination of a lot of different meetings that happened, high-level meetings this year. We wish that came earlier, 2 or 3 years earlier, since Biden took over. But it's never too late, and we're seeing some deals being struck here with regards to drugs, with regards to military and climate. But we want to see more deals happen between the two countries, especially on tariffs. That's an easy one. And also on technology, somehow we're able to find middle ground between the two countries. Next slide, please. So basically, you look at valuations today. Obviously, China is low valuation, much better than its history, and also lower than emerging markets like China. That's why we're overweight in the ETF now to China. But also EMX China has also decent valuation too, also below its history, not as much as China. And when you look at the two compared to S&P or other asset classes, these two, the emerging markets is really in a different league right here, right? You have much lower valuation and actually potentially better growth prospect, which we can see on the next slide. You see here the red line and the blue line. The red line expecting China to do 16% next year, and better growth prospect than the U.S. equities for sure, as we're seeing now earnings and companies starting to lower guidance. So I think emerging markets is a very well positioned now for the next 3 to 5 years, and in short term, we believe China will outperform emerging markets ex-China due to low valuation and higher growth potential. Next slide, please. So this is it from us. I hope that was useful. We just wanted to introduce our new ETF that you can check online or you can call us for it. I think it's a great way of looking at emerging markets now, by simply just breaking out China and ex-China and using cash to dampen the downside. And then with regards to emerging markets like China, I think it's a really great time to start looking at adding an exposure there, especially if you're very overweight in the US. I think it may be time, especially now with the dollar breaking down and we're seeing the yields breaking down. We may be, this may be the start of a new run in emerging markets that could last a decade. So thank you so much for joining, and we're happy to take your questions.
Thanks, Anthony. And just to remind our viewers that if you are joining us via Zoom, You could just enter your question directly into the Q&A box down below on the Zoom, or you could email your questions to info@kraneshares.com and they'll make it through here. And as we as we wait here for kind of us to sort through these, one question that I think is important to address, Anthony, when I talked about the analysis that we had done in allocating to China versus emerging markets ex-China and looking at the historical results, there's this question about A-share exposure. Can you talk about how the KALL ETF specifically invests in A-shares and how that may be different than other exposures to China in the marketplace?
Yeah, no, absolutely. So the way we approach our model portfolios here is one, we build what we call an enhanced benchmark, right? So we look at the industry, we see how we can do it better, right? If we can. And when you look at emerging markets, there's one implication here or restriction. It's the A-share market. It's restricted at 20% of inclusion, if you guys know. So MSCI China only has 16% of it in the A-share market, right? We're looking for MSCI to start increasing. That's going to increase over the next 3 to 5 years to 100%. So what that means is a lot of flows into A-shares from the indices as this restriction is relaxed, and the inclusion cap is increased. So basically, the way we look at this is that as investors here, we don't have to comply by that restriction. So we start from this. Our starting point is what's actually A-share value or A-shares market value compared to the full China exposure or full China universe. And if you look at it from a market cap perspective, which MSCI China All Shares does, A-shares is 40, 45, sometimes 50% of the full China opportunity. So that's why in this model we use KALL, which tracks the MSCI China All Shares versus the MSCI China, and that's basically the big difference here is the full inclusion of the A-shares.
A great response. So we're really taking into account the full market opportunity available to us as China investors. There's a question here about emerging markets ex-China specifically, and I'm just going to read it verbatim. The emerging market ex-China trade has been popular this year, in a way dominating EM ETF flows. But now we're seeing all this positive momentum and optimism out of China. Growth signals are improving with data from China suggesting continued recovery. Does this threaten the popularity of EMX China strategies? And are we likely to see outflow soon? And maybe I'll address this. So it's true. I mean, even with our own emerging market ex-China strategy, we've definitely seen flows this year and a lot of interest. But I'm pretty sanguine on where it goes. And partly it's because we're seeing underweight exposure to both emerging markets and China that's nearly at record levels. In other words, a typical investor's portfolio doesn't have enough of either. And so I think some investors were tiptoeing in and saying, geez, I want to have some of this emerging market exposure because the next decade could be very different than the last. And so they started with the MX China. I think what we're going to see now is investors adding to their China weighting as the China recovery takes hold. But that doesn't mean that they have to sell their emerging markets ex-China exposure. So in a roundabout way, I think investors are going to have much more sophisticated portfolios because of what we're seeing in this buying behavior. I think it actually leads to where we want investors to be, but really in a two-step process. Buying emerging markets ex-China first, and then following on by buying China as they start to see all the green shoots emerge. Anthony, here's a great question. How long do you think KEM will be overweight China?
Well, this is not, it's hard to predict how the markets are going to react in the next, few months or quarter. Anything could happen especially from the China side, that could change the equation very quickly, right? And this is why we don't really recommend market timing in emerging markets. It's just having your exposure and some, and try to calibrate it up and down a little bit as you see fit. But but continue to have it, because you never know when things are changed. So if as the Chinese economy recover, what we're looking for here is consumer confidence to come back, right? Because we want the consumer to start spending again, and we know consumers have very high savings today. So as they feel better, they're going to start spending again, and we could see higher levels of spending in the short term than we've seen historically, right? Because of the magnitude of the savings today. So basically, this could happen very quickly if the government announces some policies that are related to consumptions, or it could, if the government continues to kind of ease to do these slowly as they're doing now, it could take probably two or three quarters for China to come back fully to mean, right? Like basically to close that gap in valuation between emerging markets like China and China. So basically, it could be as quickly as 1 quarter, or it could take as long as 3 quarters, in my opinion.
Right. And keep in mind, right, that this model is designed to rebalance at least quarterly. So whether we're overweight or underweight, it doesn't mean that that's a secular view for us. We expect over the long term that our average weight to China will be in that 60-40 type range, but that at any point in time, it could be meaningfully different. So the model is designed to work with a fairly short time horizon. Here's a question here on the fees for the strategy. So I don't know if you can, let's go to the slide that shows, kind of the composition and shows the overall expense ratio, and I'll talk a little bit about the fees. Okay, right here. So you could see that the blended expense is 49 basis points. And what that represents is the weighted average of the underlying ETFs that we invest in, plus a 10 basis point management fee. So we charge 0.1% of management fee for implementing the model. So it's very efficient in that regard, and also very transparent, because you could see here, this is effectively like our fact sheet. We're showing all the same things that we would show for any other of our ETFs, including the composition, the holdings, and so on. So 10 basis points is the answer, but bear in mind that the overall fee is currently 49 basis points. And that will vary depending on the weighting between KALL and KEMX.
So basically, you're getting the active approach at a much lower fee, right? Because if you look at the average mutual funds or active funds, they're closer to 70-75 basis points.
Exactly. Anthony, you talked a little bit about valuation, and highlighted how the PEs, for example, for China are quite low. I mean, kind of high single digit, low double digit, 9-10x. Can you make some comparisons between the valuation of China and emerging markets versus the US?
Yeah, no, definitely. So, and this has been happening for the last 2 or 3 years today, right? It's taking longer than we expected, but that's also has to do with market conditions that are changing very quickly, right? First, it was kind of the stimulus driving everything, driving low liquidity, a lot of liquidity and low interest rates in the U.S., which was trickling into the U.S. market. And this is how we were able to see a really impressive performance from the US and big resilience also from the companies in the US. But that kind of drove valuation really high. And if we're looking now at the S&P, I think S&P is at least 1 standard deviation more expensive than its history, right? And if you look at it today, I think forward PE is closer to 19-20, where its history is actually closer to 15-16. You look at that in emerging markets, it's truly the flip side of that. It's valuation are looking at least 1 standard deviation lower, more so in China than in emerging markets like China. Add to that that rates in China are very low, and the government continue to stimulate, and we expect more stimulus in the future. So basically, you are getting really a juiced up economy, or like economy that is expected to have the full support of its government, the full support of its industries at a very cheap valuation today.
Yeah, I mean, I think it's really interesting, right? If you throw away recency bias and how the relative performance between emerging markets and the US did in the last 10 years, recognizing that the US market was just on a tear in every way. And even this year, right, looking at the Magnificent Seven and seeing what their performance represents within the S&P. But if you were to take a step back and try to build a durable portfolio for the next 10 years, you would have to take into account the fact that US valuations are so far above average and other countries and other regions are well below average. So I actually expect for some investors, especially the forward-looking investors, that the US will act as a funding source for emerging market and international investment exposure.
Not to mention the potential impact from currency too, Jonathan, right? As the USD comes.
Yeah, it's hard to believe, but the US dollar has strengthened by, call it 30 to 40% over the last decade. And so that's that's been an extremely nice tailwind for US stocks and a headwind for everything else. And that relationship could change on a dime as well. And then, we're getting requests for the presentation. We are going to have it available. So please send your request to info@KraneShares, and we'll have a version of the presentation available for you. And Anthony, any final comments or thoughts before we wrap up?
No, thank you, Jonathan, and thank you all for listening in. I hope you enjoyed, the presentation. That was good information for you. I think it's a really good time to give emerging markets a look. And for more information on the performance of the model that the ETF is tracking, please ask us for track record or for performance, or you can log into KraneShare Model Portfolio's website and see it for yourself.
And don't forget to sign up to ChinaLastNight.com if you want daily updates on what happened in China within the last 24 hours. Thank you, everybody.